Let's talk about the US tax code, but probably not in the way you're used to thinking about it. We're not going to treat it like a big, scary book of rules. Instead, we're going to deconstruct it like a machine, a system of incentives that's built to make our economy run a certain way. So let's dive in. Here's our roadmap. First, we'll get right to the heart of the code's core logic. Then we'll see how that logic applies to two totally different assets, real estate and crypto. From there, we'll cover the tools you can use for your personal tax situation, talk about the huge difference between just being compliant versus having a real strategy, and wrap up by looking at how the rules are changing as we speak. Okay, first things first. Before we get into any of the nitty-gritty rules, we absolutely have to understand the fundamental idea that drives the entire system. This right here, this is the most important mindset shift you can make. If you only see the tax code as a penalty for making money, you're missing the entire point. It's so much more useful to see it as a rule book for a massive economic game, a game that has very clear ways to win. You see, the government has things it wants done for the economy, right? And it's a lot easier to get private citizens to do those things by offering them a reward. That reward is a tax break. So the tax code is really just the government's primary tool for getting us to do things like provide housing, invest in businesses, and take risks. So enough theory. Let's see how this actually plays out in the real world with our first big example, real estate. This is where you can really see the power of that incentive system. This is one of the wildest, most powerful concepts in the entire tax code. It's called depreciation. Basically, the government says that the physical building on your rental property is wearing out over time. And it lets you take a tax deduction for that wear and tear, even while the property itself is very often going up in value. It's a phantom expense that saves you real money. And these are the official timelines for that write-off. For a residential property, you get to deduct its value over 27 and a half years. For a commercial building, it's 39 years. This isn't just a random number. It's a long-term benefit designed to encourage you to invest in housing and business infrastructure for the long haul. Now, check out this other powerful tool. It's called the step-up in basis. Imagine someone buys a house for, say, $300,000. They hold it for decades, and when they pass away, it's worth $6 million. Their heir doesn't inherit it at the original purchase price. No, they inherit it at the current market value of $6 million. All that growth in between, that $5.7 million, it becomes completely tax-free. It's an incredible mechanism for passing wealth to the next generation. So when you see this number, 27.5 years, just remember what it is. It's a direct signal from the government. They are incentivizing you, rewarding you for buying, holding, and maintaining housing for a very, very long time. All right, let's make a hard pivot. We've seen how the logic works for physical assets, but what happens when we jump into the totally different world of digital assets, like cryptocurrency? And here's the fundamental difference. The whole idea of depreciation is based on a physical building getting older and wearing down. But a digital asset like Bitcoin, it doesn't physically decay. There's no wear and tear. So that massive deduction we just talked about, it just doesn't exist for crypto. You're playing a totally different game. So when do you pay tax with crypto? Well, just buying and holding it is not a taxable event. You're in the clear. But the moment you realize a gain, that is when you sell it for dollars or swap it for another crypto or even use it to buy a cup of coffee, that's when the tax bill gets triggered. Each of those is a taxable event. And this all comes down to one single critical decision by the IRS. They decided that crypto is not currency, like the US dollar. It's property, just like a stock or a piece of art. And that one classification dictates absolutely everything about how it's taxed. Okay, so we've looked up big asset classes. Now let's bring it back to the standard tools that are available to pretty much everyone for managing their own personal tax bill year after year. These are some of the most common and powerful tools out there. For 2025, you can put away up to $23,500 in a 401k, and $7,000 in a traditional IRA. Every dollar you put in there reduces your taxable income right now. And don't forget health savings accounts, HSAs. They're like a triple tax-advantaged powerhouse, with limits of $4,300 for individuals and $8,550 for families. And it doesn't just stop with retirement accounts. If you itemize your deductions instead of taking the standard deduction, a whole new set of doors open up. You can deduct things like mortgage interest, student loan interest, any money you donate to charity, and even big medical bills. Each one is another incentive for a specific behavior. This leads us to a really crucial distinction, and it's all about your mindset. It's not just about what you do, but how you think about your taxes in the first place. Think about it like this. Tax accounting is about driving by only looking in the rearview mirror. You're just making sure everything from last year is recorded correctly so you don't get in trouble. But tax strategy? That's about looking forward, out the windshield. It's a year-round process with one simple goal: to legally and ethically structure your life to pay the least amount of tax possible in the future. And a lot of experts point this out. People often think their CPA is automatically a tax strategist, but their primary job is compliance, making sure the numbers are right. Strategy is a different discipline. Understanding that difference is the key to going from just reacting at tax time to being proactive all year long. And finally, let's talk about why that forward-looking strategy is so incredibly important. Because if you think the tax code just sits still, well, you're in for a surprise. The rules of the game are always changing. Here is a perfect real-world example happening right now. You've probably heard about this Form 1099-K. It's what payment apps use to report income. The constant changes to these rules are a flashing neon sign that the government is getting much more serious about tracking money from the gig economy and all those little digital transactions. And just look at the trend here. It's not subtle, is it? Before 2022, the reporting limit was a pretty high $20,000. For 2024, it's down to $5,000. For 2025, it's set at $2,500. And the long-term plan is to bring it all the way down to just $600. The net is definitely getting tighter. And it's not just small reporting rules. We've got massive foundational laws that are literally on a countdown timer. Key parts of the Tax Cuts and Jobs Act are set to expire in 2026. Unless Congress acts, things like the mortgage interest deduction limit and the child tax credit are scheduled to change dramatically. These are huge shifts on the horizon. So we'll end with this question. When you know you're operating in a system that's constantly changing, just being compliant with last year's rules isn't enough. The real game is building a strategy that's smart enough for today and flexible enough for whatever rules they come up with tomorrow.